we have talked about the qualitative characteristics of financial reporting. Now let's look at the assumptions underlying US GAAP. So there are 4 assumptions underlying US GAAP: economic entity assumption, going concern assumption, periodicity assumption, monetary unit assumption. And here are the explanations for the 4 accounting assumptions. The first one is economic entity assumption. So it is basically that the economic events of the firm should be separated from its owners. If an owner is having any expense, it should not be viewed as the firm's expense. So the firm is its own economic entity. Going concern assumption. In the absence of information to the contrary, it is anticipated that a business entity will continue to be operating indefinitely. So this assumption is actually important because not all firms will operate indefinitely, but for accounting, we need to make an assumption. And the assumption which is making here is the firm is going to operate indefinitely. If this assumption is violated, or in other words, if there's any evidence which shows that the firm may, for example, go bankrupt or stop operating in the near future, then the firm should do its accounting differently. Periodicity. The life of a company can be divided into artificial time periods to provide timely information to external users. So the time, we all know that the time is operating in a going concern, it is operating in a continuing basis. However, we cannot provide information to outside users in a continuing basis. That will be too costly to the firm. So as we just mentioned, there's a cost and benefit constraint we need to consider when providing financial accounting information. So what we end up doing is we kind of divide time into artificial time periods and provide information to the information users once in a while. So we don't provide information in a continuing basis. Instead, we provide information, for example, once a quarter or once a year. Monetary unit. Financial statement elements should be measured in nominal unit of money without any adjustment for change in purchase power. So which means just for the US, we measure it in US dollars. No matter how high the inflation, is going to be this year, we're not going to adjust it. So it is just going to be measured in the nominal unit of money. So those are the 4 accounting assumptions. And then we also have 4 basic principles underlying US GAAP. The first one is called measurement principle, revenue recognition principle, expense recognition principle, full disclosure principle. And I'm going to explain each of those in turn. First of all, measurement principle. So there are 5 measurement attributes. Those 5 measurement attributes, which is the way we measure. So we have historic cost, net realizable value, current cost, present value, and fair value. So for the same item, we have 5 ways to measure it. And US GAAP employs a mixed attribute measurement model. What do we mean by mixed attribute? Which just means that for different items, we tend to use different ways to measure. We can choose from these 5 measurement attributes. We may use different ways to measure. For example, for land, we measure it at historic cost. Account receivable, net realizable value. Liability, usually at present value. Investment, it is measured usually at its fair value. And then why do we choose different ways to measure for different items? So it is usually to maximize the combination of relevance and faithfully representativeness. So to make the information most useful. Then what are the difference among those 5 measurement attributes? So here is an example for you. Supposedly, I purchased a desk, and supposedly I purchased the desk for example, 10 years ago for $100. So this $100 is called the historic cost. And also, supposedly, if I'm going to sell this desk in 2 months, and then the expectation is that I will receive $120 if I sell it. And this $120, it is called net realizable value. Also, supposedly, if I want to replace this desk with a desk with the same condition, if in that situation, I need to pay $110. So if I'm going to replace it with something of the same condition, I need to pay 110. Then this 110 is called the current cost. Supposedly, when I'm using this desk, it will bring me $10 per year for the next 10 years. So if I use 5% discount rate, using discounted future cash flow model, the present value of the desk is $77.22. This $77.22 is the present value or the discounted value of this desk. And also supposedly if there's a market, if it's just like a market for stock, there's a similar market which trade desk on market. And the desk with the same condition are traded on market for $90 each. So this $90, that is called the fair value of the desk. So those are the difference between different definitions. And as you can see that for the same item, there are different ways to measure it. And then the question is, according to GAAP, which way should we use to measure the value of this desk? And then the answer is 100 minus cumulative depreciation. So in other words, according to GAAP, we use the historic cost minus the cumulative depreciation. That is how we measure a desk, which is one kind of PP&E, property, plant, and equipment. For the specific item or item with that nature, we use the historic cost minus cumulative depreciation. So that is the what GAAP is telling us to do. So that is the measurement principle. And then the second principle is revenue recognition principle. So it's basically when do we recognize revenue? And then the principle tells us when a company agrees to perform a service or sell a product to a customer, it has a performance obligation. And when the company satisfies the performance obligation, it recognizes revenue. So we're going to talk more about it later in the class, probably upon the end of this course, when we talk about revenue recognition. And then expense recognition principle. So expense, kind of the rule here is expense, we need to follow the revenue. So if the cost has a direct relationship with revenue, we recognize in the period of revenue. For example, when the firm made a sale, it recognized revenue at the same time it needs to recognize cost of goods sold. If cost does not have a direct relationship with revenue, expense as incurred. So for example, for the R&D cost, usually we expense it as incurred. So that is an example.